Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Verizon, ticker symbol VZ. This idea came from subscriber Sanjans1552. He asked me if I could review Verizon and NVO, and I decided to start it off with Verizon because I feel like it's more in my wheelhouse, and I can kind of give a better description of the type of investor I think should be buying Verizon and the potential risks and rewards that come with Verizon. So let's get into that. Verizon obviously does cellular, internet. They own a lot of the infrastructure. They have very steady revenues, a decent dividend. Overall, they're just a very solid, boring company that doesn't really have a lot of growth in it, but pays a good, solid dividend that's pretty consistent over time. I think that the type of investor that should be investing in Verizon should be someone who just needs a dividend income for the long term and doesn't necessarily look at growth of the stock overall. I think that Verizon's a safe play for someone who wants to hold the stock and just wants to be paid the dividend, doesn't want to reinvest it and just collect that money. My reason for that is the stock hasn't really demonstrated that it can grow the revenue. It's demonstrated recently that it can grow the cash flows, but overall, I think that there are a lot of better defensive options for compounding your dividend and just snowballing in general. Like, I think waste management would be a way better pick if someone has a longer time horizon. But I think if you're trying to preserve value and get a decent, consistent return on your money year over year, I think that Verizon is the type of stock that you want to look at because the dividend is so high and it's so consistent and strong in what they do. Now, I was really thinking about the potential upsides and downsides, and I really came to the conclusion that they're very neutral because Verizon, overall, the thing that's the biggest threat to them is if cell phones and internet go away and we transition into something else. But the biggest strength for them is if we go to something else and they're able to adopt the infrastructure. So I think there's probably a equal chance of both. I don't really personally see people getting off of their cell phones, but technology does rapidly change, so you have to deal with that risk. But you also come in with the potential reward of them being able to pivot into something new and make more cash flows and revenue off of that. I think that these kind of balance out equally. Another thing I want to add about Verizon that makes it a really good value preserver is that a lot of the infrastructure that they've built is very inflation proof because once it's there, it's pretty much good. There's not really a lot that is changing the value of that. Once you spend the money on a cell tower in 2010, that's the price that you paid for it. Obviously, you have maintenance and things like that, but that doesn't even come close to the amount that it costs to actually build the thing. Overall, I think, again, this is the type of stock for someone who is in retirement age and wants a consistent dividend. I was reviewing the stock through my weighted average cost of capital. The debt is about equal to the market cap or very close, which I really don't like, especially with the current interest rates. But I think that Verizon will be able to reliably sustain this, and it may be helping them with a potential tax shield. I don't think this is a case like Duke Energy where the amount of debt is just so crazy that it wouldn't make sense for me to want to invest. But that is something to kind of keep on your radar as we go into this Verizon stock analysis. Now, looking at the actual stock, it is up 6.13% in the past year. The market cap is $179.3 billion. The price to earnings ratio is very low, which is to be expected, 10.27. And the dividend yield annually is 6.36%. So you're getting an excellent return on your money, higher than the risk-free rate in the terms of the dividend. But again, I think that the past year growth is probably more of an anomaly compared to other years just because the revenue looks very similar each year, and some years it depreciates, some years it goes up. The cash flows have been going up, so I'm guessing that they're better with actually managing their cash flows, or they don't have as many projects that they're financing. One thing that I'm also thinking about with Verizon, just kind of off the top of my head, is that if these tariffs are permanent, it may be expensive for them to get the materials to build more, so that could be hurting the stock, which would be a legitimate reason for it to dip. But the 52-week low is 37.58. The 52-week high is 47.36. So a little bit of volatility there, but not anything near what we've seen with some of the other stocks, especially with the massive drop off. And you can see from the chart that it hasn't really dropped off as much as a lot of the other stocks. You're kind of getting an in between number on the 52-week high and low. And overall, analysts are mainly rating it a hold, with 11 rating it a strong buy or a buy, and 14 rating it a hold. Their analyst price targets range anywhere from $40.79 to $55, with the average analyst price target of 47.53. Again, I think that this is a very specialized stock, and this is something that you probably should dollar cost average into as it goes lower. You should probably be looking to add more if you are someone who just wants essentially almost like a fixed income thing with a little bit more risk, obviously. From a DCF basis, which we're going to see, it looks like an incredible deal. But practically, when you think about it, it doesn't make sense that they're really going to be able to grow that much, because I'm pretty sure Verizon is in most of the markets they could be in, and it is very capital intensive. You're not getting these great margins that you're getting from something like a semiconductor brand, or you're not getting the consistent organic growth that you're getting from, again, my favorite defensive stock, Waste Management. It also has difficulties that REITs don't really face, because whenever REITs can't figure out how to increase their cash flows, they just buy another property. Verizon has to get more customers or find new ways to make their costs more efficient, which I do think that they're doing successfully, but the high rates are not helping them. So overall, and again, I'm not a financial advisor, but in my personal opinion, I think that this is the type of company that someone who is in retirement age and just wants the steady dividend, doesn't need to reinvest it, doesn't care how the stock is moving, because it's probably going to be fairly flat compared to the rest of the market, but it's going to sustain its value pretty well. This is not something you should be buying into if your time horizon, if you're not already in retirement or you don't need the income. This is in some ways a value trap, but I think it's for a specialized type of investor specifically. Moving on to our weighted average cost of capital, again, we can see that out of the debt and equity weighting, 48.43% of the weighting is in debt and 51.57% is equity, or just the market cap. So their debt is a very large amount, which is to be expected when you're buying assets that are this expensive and you have such a long time horizon and paying that debt off. I mean, you think about buying something like a house, you have a 30-year mortgage. I'm guessing they have a lot of long-term debt on things like cell towers and things that just cost a lot of money up front that they plan to make up with from people paying for their cell phone services and their internet and things like that. It's obviously very expensive up front to run an internet line or do different things like that. But over time, you can make up for it in the revenues that you're getting from people. We can see that the cost of equity here is 5.39%. That's with an average market return of 7%, a risk-free rate of 4.317%, and the beta, which is very low at 0.4, which again shows that, it correlates with the S&P, but it really doesn't move relative to a lot of other stocks. So if you really don't like volatility, I would cautiously say that this is probably a good pick, because that beta is from the average of the last 5 years. So history has shown that this stock doesn't really like moving that much. We can see, too, that their cost of debt after tax is lower than their cost of equity. So from a weighted average cost of capital perspective, this is actually kind of good for them to have this debt. Obviously, that I don't agree with that just from a logical thinking perspective. But for the purposes of modeling, this does increase their valuation. And then if we go here, we can see that the average revenue growth is only 0.31% since 2021. So obviously there are a lot of defensive stocks that would look a lot better on paper, right? I mean, have better revenue growths, have better history. And this is kind of a common theme that you'll see a crazy upside like this on stocks that really aren't able to grow very well at all. And Verizon's no exception to this. I think that there probably isn't a lot of growth, and that's why I kind of think that you might get a little bit here and there, but you're also going to get some declines over the long term, it's really just going to make very similar revenues into the future. And that's okay for some investors. It's not something that fits into my portfolio. I think that this could be slightly undervalued. I know that the DCF is screaming that there's 280% upside, but I realistically would rather have my money in something that's growing the revenue pretty consistently and doesn't have as much debt, because I really don't like the amount of debt that they do have. I think that it is a little bit concerning, but I also think that because it's Verizon and because they have such a large customer base, obviously they can sustain that pretty reliably. Overall, I think that if you're going to get into this stock, I think that it'd be wiser to get in now than it would have been at obviously the peak at 47. I think that you're getting a really good annual dividend yield, but I would caution people with a lot of time that it probably would make more sense to buy into something tech heavy. And I know that the upside from the model is saying 280, but I have to kind of divert away from the model in this case because over time, I mean, I think that a lot of things are just helping Verizon in the model, and it's not really accurately predicting what the value should be. Because when you're thinking about it fundamentally as a business, they're not able to really consistently grow their revenue. Everything's kind of very similar. The cash flows do look significantly better over time, which is a good thing because that means that they're having more net income over time. They're being more efficient with their capital, or it also could just mean that they're not committing that capital to infrastructure that they need, which is why they're not getting growth in revenue. So that's obviously a double-edged sword. But overall, again, I it's just my opinion that I think that even though this looks really good on paper and in theory when you use a DCF model on it, um, this stock should stay for retirees and people that want that big dividend and aren't going to reinvest it and just want to take the cash instead of investing in something like a treasury bond. So if you want more risk and you're at retirement age, I think that's the niche that this stock really fits into. I don't think it fits into the niche of people who want compounded gains over time, consistently growing. That's kind of my review of Verizon. Let me know what you guys think. Um, Obviously, I hammered them pretty hard. I think there's a specific niche that could obviously benefit greatly from this stock, and I think that it's going to retain its value very well. But I don't think that the stock is actually going to be able to grow consistently very well, and the debt concerns for me are a little much. So, thank you for watching. Bye.